Markets will never be the same, and of course, it's all thanks to NVIDIA. With the 10-to-1 stock split in force on Monday, the reduced options premium will change the way the stock trades, in my opinion. And it was fun while it lasted, but those days are over. And don't forget, it's a CPI inflation and Fed week with Powell on the mic Wednesday at 2:30. Welcome to the Trade Brigade Weekend Update. My name's Matt, and we've got all of that to cover and more in today's episode. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure last week, we've got ourselves a green hammer-esque style bar where, of course, the lower wick emerges from some sell-side pressure. However, we know buyers respond off the lows of the weekly range. They're able to push prices back up to the opening print and, of course, through the opening print for range expansion in the upward direction, and they do achieve a pretty strong close in the upper third of the weekly range. So that's bullish in terms of structure. On the location front, we do have on the bar-to-bar count a higher low as well as a higher high, and that close is a brand new all-time high close on the weekly time frame and firmly outside of and above the entire previous week's range. So buyers go 2 for 2 on the weekly count. If we're thinking about the overall context of the previous all-time high, you'll also notice that previous resistance is now acting or continuing to act as support in the lower wick of last week's bar, another bullish takeaway. The trend, of course, remains in the upward direction with lows, higher lows, and higher lows being found here. As long as we're over the low of the red hammer candle low, I would argue that this is looking like bull flag consolidation. The reason I would confidently say that is because if we come in with a Fibonacci from the low of the April pullback to the all-time high, all of this is taking place over a 38.2. So I really wouldn't want to see a pullback deeper than that, but any consolidation up here is bull flag consolidation on the weekly, and we would look for that to resolve in the upward direction over time. Let's take a look at our anchored VWAPs on the weekly time frame, and they are still offering confluence of support around that 520 area. We know that the major line in the sand was 522.75. So all good here on the weekly time frame. We could take a look at the volume profile as well and just reinforce the idea. If we just minimize this a bit here, the high volume node is still acting as support. So high volume node acting as support near the lower wicks of last week's range. This again is a bullish indication. Let's drop it on down to a daily time frame chart here and start evaluating this week's expected move. The expected move is in this box right here. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 541.68, and that of course would imply a higher high in the trend cycle as well as a brand new all-time high. If we're contained by the lower bound, the number's at 526.39. It's technically implying a higher low, but it's not really at an ideal location. The line in the sand that I would use on the daily time frame chart comes from the bottom end of this balance range and the 2-day highs that we broke out over on the gap fill reversal from Wednesday's session. That level is at 528.40. So the trend, of course, is up. We know that this is an all-time high. We know that we can afford a higher low pullback. If something like that were to emerge on the daily time frame, the higher low would likely want to look something like this for an ideal sort of continuation of the trend. Let's talk about the bar that printed on Friday as well, because it's not a solid green-bodied bar. We can read into this just a little bit here. It's a green inverted hammer where we did look into blue sky territories over the Thursday high, but we were unable to close outside of the Thursday high, and we actually closed weaker towards the lower third of that individual Friday range. You'll notice that the Thursday and Friday lows back-to-back are fairly equal, and these lows are almost dead on to the bearish engulfer high. So it's my view that a daily pullback will likely emerge when and if you can break down underneath that level, and perhaps the target would be down here, closer to the retest of the 2-day high breakout point, the gap fill reversal, and the bottom end of the previous balance range from over here at 528.40. If we can spot buyers here for a daily higher low, that would look picture perfect for continuation of the trend in the upward direction over time. Of course, the first target would be the equal high up here, closer to 535. There's not much else outside of that to talk about on the daily time frame. Obviously, moving into blue sky territories, the upside takes care of itself. $1.50, any intraday levels that form. let's take a look at the hourly time frame chart where we can start to get a little bit more nuanced here and understand some specific situations headed into this upcoming week. So let's keep it simple to begin. Of course, starting with trend, we have lows, higher lows, higher lows. This gap fill reversal could be a higher low, and you're starting to get some higher lows in here on the pullback low from Thursday as well as Friday into the afternoon. So the most picture-perfect thing that could happen for the S&P to continue in the upward direction would be holding on to these equal lows at 533, the top of the bearish engulfer. If we're above that, then great. This is bullish consolidation. You could call this some sort of bull flag. We would look for that to resolve in the upward direction over time. You'll notice that we have a dimmed out gray level here at 535. If we were to spot consolidation and then a break and higher low over 535, I would trade that into blue sky territories, aiming at the all-time high and then continuation into those blue skies. If we're underneath 535, that's where things start to get a little bit interesting for a possible head and shoulders, right? You could start to envision how this perhaps turns into a head and shoulders with a high, a lower high. You've got all of these equal lows. If you break down under the equal lows, which is 533, the bearish engulfer high, then you're looking for a pullback. But are you overstaying your welcome is the next key question to ask. And personally, I think the answer is no. The top of the balance range in here can also act as a daily high or low. We talked about the line in the sand being down here at 528.40, but you could also get a higher low well above that area. If this turns into an hourly double bottom, where's the long? I mean, this is a long right here on the higher low back over 533. Because most of the data points that we're about to look at today would side with the bulls, I think that a mild pullback's not the end of the world, and we're still scouting the dip buying opportunities. Remember, this has been a dip buyer's market, right? Dip buyers here, rewarded into the afternoon. Dip buyers here, rewarded into the afternoon. Same thing on the Tuesday session, closing near the highs. Even the gap fill reversal dip buyers were rewarded. Now, we are getting some stagnation in the momentum in the upward direction on that Thursday and Friday session. Notice that on Friday, as we broke out over the Thursday high, we were unable to find that higher low over the level at 535. So I want to fully acknowledge that, again, nothing is explicitly bearish yet, but the momentum is slowing down up here. And if this pattern starts to emerge, I'll look for a pullback, but I'm probably not shorting the market aggressively. I'm more so looking for dip buyers to step up at some of our major inflection points. Once again, the first big one is here at 531.40. If we move underneath 531.40, so let's say that the market starts to do something of this sorts, I think that we could achieve the daily higher low pullback into 528.40, and there's probably a short that unfolds from point A to point B down here. But when we get to point B, once again, what's the thought process? On the hourly time frame chart, I wouldn't really be an aggressive short. I would start trimming profits here and instead flip my bias to say, okay, can we spot the double bottom? Can we get a retest of the two-day high breakout point? Remember, Tuesday was an inside bar. The breakout was on Wednesday's gap fill reversal. So I'd really be looking for support at 528.40. Now, a lot of this should be taking place, or ideally these technicals hold up ahead of the FOMC on Wednesday. On Wednesday, when 2 o'clock comes rolling around, all of the technicals go out the window. The market is at the mercy of what Jerome Powell has to say. We'll still be watching key levels, but the structure, the patterns, the types of participants we have in the market is subject to change once again Wednesday at 2 o'clock. So that's primarily what I'm looking at here on the hourly time frame chart. If we bring out the Fibonacci's from the lows up to the highs, you'll notice that the 38.2 is no longer confluence with our daily line in the sand as it was on Wednesday's close. So this level at 530 is also interesting because we know if the market does offer some sort of head and shoulders here and we start to break down, let's say we do this, if there's a double bottom off of 530, and when I say double bottom, it could be that pattern, it could be a 15-minute inverted head and shoulders, it could be a simple hourly hammer candle, right? If we get something that's supportive off of this previous area of resistance that's now trying to act as support, where's the long back in the upward direction, right? It's just simply put, over the neckline of that pattern, we would have to respect the neckline of the head and shoulders breakdown at 533, but overall, considering that the momentum and trends are in the upward direction, the ideal target would be battling for an equal high here on the hourly time frame, closer to that 536 level. Let's clear up the Fibonacci's and let's come in here with our intraday anchored view apps. And what this would suggest is, once again, the head and shoulders neckline, if we're below that, we're breaking down underneath the Wednesday gap fill reversal anchored view app. So it would make sense that we could travel in the downward direction. This cluster of anchored view apps really coming from the low from back here. This was your bearish engulfing bar. This was the gap up from CPI in the previous month, right? All of that's still clustered around 528.40, continuing to reinforce that as your key daily line in the sand. So I think the roadmap is fairly straightforward here on the hourly time frame chart. If we want to dial back some of the bullish expectations, we can take a look at the market internals. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. If we're thinking about what technically happened on Thursday and Friday, the market was not trending anywhere. It was really more so balancing in a 2-day range. But what was the market internals, or what were the market internals actually suggesting? Well, neutrality in terms of volume flows on Thursday, definitely more bearish on Friday. Now, I want to caveat some of these bearish takeaways with the fact that they were not really substantial, right? We were not underneath negative 300 million as the market was pulling back into the afternoon on Friday. If we look at the advanced decline line, it's negative on Thursday and it's a bit more negative on Friday. If we look at the cumulative build, it's negative on Thursday and a bit more negative on Friday. However, we're not in trend lower zone here on the advanced decline line, and we know that substantial reads are net positive or negative 5,000 out of the cumulative build. And what you'll notice here is we hardly got to like negative 1,700 on Friday. So if I ask myself, are stronger sellers really getting involved in this market? The answer is no, but stronger buyers, momentum buyers, dip buyers also seem to be slowing down here on that Thursday and Friday consolidation. So it's not unreasonable that the market might pull back a little bit to sort of kick off our week here. One of the things that I'm a believer in is that this end of day move out of Friday is really a sign of de-risking out of NVIDIA, right? If you pair this up around 2 o'clock, just slightly before 2 o'clock, with what was actually moving the market, we'll just quickly jump on over to NVIDIA. This is not going to replace the core segment component, but this is where NVIDIA rotated off of those highs from the day's session. So I believe that there's a little bit of this sort of de-risking from the NVIDIA stock split as we head into the Friday close, not necessarily stronger shorts positioning saying, okay, markets are going to go to zero. Let's take a brief glance over at the market profile because there are some interesting nuances here as well. Check out the video tutorial in the top right-hand corner if you're not familiar with this screen. It's going to sort of give you an idea of some of the terms I'm about to use. But if we start simply with value area and point of control, here's Thursday and here's Friday, right? You'll notice that value is actually engulfing Friday is engulfing Thursday, but the point of control is definitively lower. So does that support more of the bearish argument? I would tend to think yes. A lot of volume was conducted near the lows, and there's actually a really strong excess high here in H period. That would be the proper end of the auction. That's pretty firm, I would say, as an all-time high, not the improper end. So I like that as potentially holding. And what you'll also notice is we have this really mechanical level here at loosely, let's call it 53.52, right? You have your J period single prints from Thursday, then you have your A period single prints from the Friday session. If you were to break down underneath that, I think you could get a premature, again, this is a trade. This is not like we're hanging on for dear life expecting markets to reverse. This is a trade, but underneath 53.52, I think you could at least target the Friday low. You could target, that would be the 533 level on your S&P 500 cash ETF spiders, right? The next and last thing to point out on the market profile is just the double distribution from the Wednesday session. You'll notice that D period, little string of single prints in here, separates an upper distribution, we'll call that D1, from D2. A very simple metric that you could use here into the upcoming week's worth of trade is, do we accept more so in that Wednesday distribution 1, or do we move through the single prints and start accepting down here? If we accept in distribution 2, the market's telling you something, right? These folks are going to be stuck as overhead supply. The Wednesday breakout buyers late to the party are going to be stuck as overhead supply. It wouldn't be unreasonable for a deeper pullback to emerge if we're getting more acceptance inside of that lower distribution. In the futures, that's going to be underneath 53.31. Underneath 53.31 is that lower distribution. If I were to do something like this, let's scrunch this chart up, and I'll show you back off. Oh, it's not going to give us all of the data here. Let's see if we can go for a quick refresh out of the ES. Bear with me, folks, as we let that come back into view. Appreciate you standing by there for just a moment. But those single prints, what I'm trying to illustrate, would be this area right here, right across those flat tops. Do you remember what this level is over in the SPY cash? It's 530. If we were to get that pullback into 530 and hold up over 530, it's a pretty decent indication, right? That it's also holding over those single prints that these upper buyers are really just putting in consolidation. And once again, it's not going to yield a deeper pullback. Along now to the QQQ NASDAQ 100 on the weekly time frame chart. What do we see here in terms of candle structure and location? So just like the S&P 500, a green hammer-esque style bar, a little bit larger of a body in relationship to the lower wick, but all the same takeaways still apply. Buyers stepped up in that lower wick, moving to the opening print, obviously through the opening print for a stronger expansion of range and still a strong close in that upper third of the range. It's a new all-time high close out of the NASDAQ weekly. It's also a close definitively outside of the prior bar's range. So of course, on the bar-to-bar count location-wise, higher low as well as a higher high. Buyers are in control of the higher time frame weekly. If we're thinking about the previous all-time high in the top of the 7-week balance range from over here, that continues to act as support, which once again is a bullish takeaway. We'll bring out the Fibonacci's off of the April low up to the most recent high. Again, bull flag consolidation takes place over 445, looking for that to resolve in the upward direction over time with great confluence out of our weekly anchored VWAPs, right? So this is going to be support there, 445, as we move forward into the future. Let's quickly check in on the volume profile, and we know it's a whole lot of the same. If we do something that looks like this, the high volume node is continuing to act as support, very similar to our S&P 500. Moving on down to the daily time frame chart. Let's firstly evaluate this week's expected move. The box is up here. We've got ourselves on the upper bound, 471.95, implying a higher high and a new all-time high. And at the lower bound, we have 453.98, implying a big time higher low. What I like more so about the QQQ weekly expected move is that the higher low intent from the expected move is above the line in the sand that we were talking about in the Wednesday update video here at 453. Now, that is slightly underneath the 2-day high breakout point. However, it keeps us above this it's sort of a volume shelf as well as just a shelf of support here from this prior consolidation. If we're above that, I would tend to think that the trend count can remain in the upward direction. If we just auto zoom this real quick and then take it on in a little bit here, we would have lows, higher lows, and clearly higher lows inside of that range would be quite constructive. Now, the other takeaway would just be if we pull back and we stay completely outside of the bearish engulfer high, because notice, unlike the S&P 500, the low of the Friday session and Thursday session are not exactly at this high. So if we pull in for a bit of a sweep underneath those lows, catch support here and move in the upward direction, that's also a really ideal higher low on the daily time frame chart for continuation in the upward direction. Now, I'd make the same concessions as the S&P 500 in terms of the candle structure here on Friday. Inverted hammer looked over the Thursday high, could not close up there, closed weak towards the lower third of that Friday range. So a pullback wouldn't be unreasonable, and a breakdown underneath 462.75 is really what kicks that off. I also think it's worth underscoring the importance once again. I know the Wednesday video didn't get too many views there, but I want to point out the difference between the S&P and the NASDAQ. We had a gap and go, or at least a gap and partial close out of the NASDAQ, whereas the S&P closed the gap all the way. This is a sign of momentum strength out of the NASDAQ relative to what we've seen in the S&P 500. Let's get a little bit more granular now, though, and bring it on down to the hourly time frame chart, as we typically do. I'm sure you can start to see a lot of the same takeaways we were just describing over in the S&P 500 with, let's dim this level back a little bit here. This is going to be your potential right shoulder area. If this is going to emerge for some sort of hourly head and shoulders, your neckline's very clear and well-defined. We talked about that just a moment ago. At 462.75, your right shoulder might be here at 464.25. Any consolidation underneath builds out the pattern, and a pullback may look something that looks like this, or even a little bit beyond that is still okay. Remember that this is single prints out of the market profile. We'll see that in just a moment. So your first major pullback, if this were to break down, if this were to offer some sort of higher low on the hourly, or I should say higher low on the daily, because on the hourly, we have lows, equal lows, right? This is a high. We would be offering some sort of lower high in this box. Lower high, lower low, right? So hourly breakdown gives you your daily higher low. I'm attentive to reversals out of this zone from 460.60 into 459.25. Again, a lot of this is overlapping to the same structure we talked about in the S&Ps. If we go beyond that, right, if there's a breakdown below, and the line in the sand here for the short to unfold would be 459.25. If we are going to look for a stronger short out of the market in the NASDAQ, I would almost prefer to see this and trade from point A to point B down here, the gap fill at 455.50. The gap starts closing underneath 456.75. If we find support for a gap fill reversal off of a double bottom, then great. This would be a great dip buying opportunity as well, repairing the structure from that Wednesday partial gap fill reversal, right? And being supportive over three equal highs. We have 1, 2, and 3 highs which acted as resistance, and previously in interaction as potential support there at 455.50. So there's a short to get there, undoubtedly. Something that does this is definitely playable, once again, from point A to point B, but I would not overstay my welcome at that area here. If the market does continue lower on the daily chart, we just described how 453 is the daily line in the sand for that higher low to be found. So at all of these locations, I would be thinking more so about pullback buys and not necessarily huge shorts where we're swinging for the fences, trying to make this market move aggressively in the downward direction. At this point, we have time frame continuity across the weekly trend being up. We have ourselves the daily trend, which is up. We've got hourly trends, which are still trying to hang on to up. Sure, there's the opportunity for a reversal, but it hasn't happened yet. We have not broken down underneath these equal lows. Let's bring out the Fibonacci's. We'll stay congruent with what we've done over in the S&Ps. I like how the 38.2 is mixed in on the low of that Wednesday session. That's pretty interesting here at 456.75, reinforcing that as a potential key area. Also, over time, like if we were to make a new high in here, even if it was just an incremental one, right? A slightly higher high would bring your 61.8 up ever so slightly. If that's confluence with 453, it would reinforce that as your daily line in the sand for a higher low, right? Then finally, what we'll do is we'll check in on those intraday anchored view apps, and it's exactly identical to the S&Ps, right? If this breaks, great, the pullback can emerge into this zone. First thought is for a reversal out of it. If we do move underneath that, your short can emerge in here. Gap fill reversal is top of mind with the cluster of anchored view apps. Let's move on over to the NASDAQ internals. You can see it's exactly the same. So on Thursday, neutral, a little bit more bearish. On Friday, I would argue that it was not as bearish as the S&P on a relative basis, not even close to negative 400 million, which is the substantial threshold in the NASDAQ side of the market. Now, we did get into trend lower zone here out of the advanced decline line, and we were much lower on the Thursday session. So maybe that counterbalances some of the volume flows and the discrepancy that we just described. And you're also getting a bit more of a strong, or I should say consistent build out of the Thursday and Friday cumulative tick in the downward direction. So this pullback does not strike me as being overly frightening. It's not like we have huge aggressive sellers ready to stomp this market into the ground. But it wouldn't be unreasonable for a little bit of give back after the substantial rally, which has taken us into all-time highs. Like, let's not forget that the market offers give and take, right? Here it is out of the market profile for the NQ futures. Same concepts. Here's your value area and point of control. Here it is on Friday, drifting in the downward direction, breaking down underneath this level, which is not mechanical like the S&P was. Breaking down below that level, you have a thin structure retracement. You do have some single-ish prints in this zone down here, and keep in mind that this is above your gap fill reversal, so I wouldn't be overly, here you go. What's the level going to be out of the NQ futures? Something that's over 18,957, 18,958. If we're over that level, bullish consolidation, no reason to even bat an eye twice at thinking about shorts. You're in this upper distribution, buyers are still technically holding on. If you're underneath that level, okay, maybe you're aiming at this gap close out of the futures. The last thing I do want to point out of the NQ is that there's not as much excess in that H period. There is excess. There's 2 TPOs you can see sticking out the top, but generally speaking, you want like a really strong bang at an all-time high. You want everybody to agree that, okay, these people are crazy, who are still bidding up here, still crazy, 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 and then it comes back in with a really strong volume taper here as well out of the profile. I mean, it's not terrible, but it's just not as good, I would say, as what we had over in the S&Ps. All right, it's time to talk about the problem child. What do we see here out of the IWM Russell 2000 small caps on a weekly time frame chart? One of these things is not like the others. We've got ourselves a solid red-bodied bar in terms of structure. Absolutely no upper wick and very, very minimal lower wick. No intention here of buyers stepping up off of these lows. Really strong close from the sellers, basically dead on the lows of the weekly range here. And this is an issue for the S&P 500, especially if NVIDIA is going to slow its roll and semiconductors are going to sort of take a back seat in terms of their upward pressure for the S&P 500. Seeing small caps pull in this aggressively does not give me a warm and fuzzy feeling about a continued tailwind from the broadening nature of the market rally. Now, it's not the end of the world. I do not want to be overly doom and gloom. You can see that we made a higher high and a lower low, so technically it's a bearish engulfer. That's a bearish takeaway, not to be doom and gloom, but we're still over the weekly line in the sand at 200. Now, it doesn't look great here, and again, I'm not trying to paint the picture as overly optimistic, like here we go, reversal to new all-time highs in the small caps. It's not where we're at, but we are over the top of the major weekly, monthly, yearly balance area at this point in time. There is the opportunity for a major higher low, so lows, higher lows, higher lows. If I just put 200 back in across the screen, that's a little bit of a zone, but you could still get the idea that a weekly higher low in the grand scheme of the trend count could be found, basically needs to be found at this area, especially coming off of this as a lower high. We are not pulling back from a higher high in the trend count. Again, all of this is somewhat concerning here, especially as NVIDIA comes into a split. We have the FOMC. We know that interest rates are likely going to stay higher for longer, even though some counterparts over in the Canadian Central Bank, as well as the ECB, European Central Bank, they've started to cut rates already, right? I think it would be a huge misstep if Powell starts to follow in their footsteps, especially seeing what's going on here. So again, the operating environment's likely going to stay higher for longer in terms of rates. That's tough on small caps. If this breaks down into the range, then it really starts to suggest more of a failed breakout again inside of this zone right here. I would really not want to see the rotation all the way back down to the bottom end of the balance, but balance rules would state that that's technically the target here. So I've got some concerns out of small caps. If we look at some other sort of outsiders, the XRT for retail, this had an aggressive week in the downward direction. If we do something like this straight off the previous highs, 1 and 2, you could also see 3 in here as well. It's got to hold. So if IWM is going to hold, retail wants to hold up over this level. If we look at something like the XBI for biotech, you've really got to get in gear here. Let's get that menu off the screen. There we are. You've got to get in gear. Look at the threat. I think everybody could agree that's, of course, the threat. The weekly structure's inverted hammer. I mean, it doesn't look good for small caps. We could even go so far as to look at something like KRE, regional banks. These guys have been absolutely hammered in the headlines recently about their, quote, toxic commercial real estate debt, right? So, any sort of breakdown below this, and I don't want to say it seals the fate of small caps, but it's definitely not going to be helpful when we're looking at all of these things in combination. Notice, if this was going to act as a stronger weekly double bottom reversal, if this was going to act as like a flag above that neckline, there's just zero acceptance over those highs. We're not really accepting over the neckline. It doesn't look great for IWM on the higher timeframes. Now, again, if we're actually looking at the Russell 2000 index, we have not yet broken down underneath 200. So I reserve judgment in the index, but some of its counterpoints, those ETFs we were just peeling through, some hesitations certainly start to emerge here. Let's go ahead and bring out the Fibonacci's off the lows up to the highs, and we know that the 38.2 needs to hold here. That's underneath the weekly inflection point at 190. Let's call that 193 for round number's sake. If we bring out on the IWM, we'll go out to our weekly anchored view apps. The entire cluster is underneath us, and again, the top of that is around 193, 194. So if you break 200, I suppose maybe there's an argument for a potential very nuanced higher low there, but I think it's very dangerous. So the threat here at least needs to be acknowledged. Again, I don't want to be overly bearish until we're under 200, until there's firmly some sort of break of that level and things are looking ugly. Then we'll change our tone. But as of right now, we're just identifying potential threats, which could certainly act as headwinds for the S&P 500. Let's take a look at the volume profile as well. And what we'll do is we'll zoom out on this. If this was really going to accelerate over these highs, was this thin volume void, low volume node? I mean, there should have been, if this is going to continue as maybe an ascending triangle, maybe, who knows? Maybe this will act as support and we, tighten up here and then we break for that move into the high volume node. That would be great as a tailwind for the S&Ps, but, sort of rejecting this and moving back into the area where there is a lot of volume. Remember that the market's just comfortable transacting, contracts, shares, what have you for the small caps around this zone. If we just stagnate in this area, again, you just lose a tailwind for the S&P in terms of a lack of breakout over here. So let's move on down to the daily time frame charts. We'll get a little bit more granular and nuanced out of the IWM. A couple of things strike me as concerning. If this was a balance range, you can see on Friday that we've certainly punctured the lows, rejection in the upper wick. We're underneath the daily 50 SMA, even after a couple of attempts, namely on Wednesday and Thursday, to hold up over this nuanced area right here, 203.25, then acted as resistance on that Friday session. Here's your weekly gap close, or I should say daily gap close into the weekly line in the sand at 200. It's right there. You've got to find buyers around this zone pretty much pronto this upcoming week if it's going to be helpful for the S&P. If we're underneath, look left, there's just this box of complete chop. It's almost as bad as what we had over the past couple of weeks in here. And the lower edge of the weekly expected move is right there as well. All of this is sort of adding up to say, Again, not bearish yet until that 200 ultimately goes, but it like first impulse is not looking good. Doesn't look good for a saving grace here out of small caps. The best thing that could happen if you're trying to remain bullish, quick sweep of that Friday low, and instantly, I'm talking about like Tuesday and on the FOMC, things go swimmingly. Jerome Powell, again, I think that this would be a policy misstep, but I'm just talking about possible outcomes. If he even thinks about thinking about cutting rates, and I said that properly. If he talks about thinking about cutting rates, right, and mentions what the ECB and the CCB, is it CCB? What they've done already, then I think your small caps do something like this, and I think you start to see a rotation back into this overall range. So like buyers would love to see something like that happen. And again, don't get me wrong, in the long-term portfolios, I'd love to see that happen, but we're just not there yet from a technical perspective, and this is looking a bit heavy on the breakdown of the overhead balance range. Let's move on down to the hourly time frame chart. With the breakdown here, you can see that clean rejection off of this level. Here was the attempt. If this was like, put yourself in the shoes of a bull, right? If you're a bull in small caps and you're looking for this thing to stay inside and contained in the balance range, great. Break higher low, needed to spot the higher low there and continue at least to the equal high, if not rotate to the top of the range. Friday completely obliterates that as a trade plan. So once again, it's very difficult to look at this chart if we're underneath 203.25 and say anything really constructive about it. The only thing you could say is the gap fill reversal might be the catalyst to find buyers back in the upward direction, but as we saw with multiple of those ETFs on the weekly, we're looking pretty heavy across the board in the places where it matters. We could throw on the anchored view apps. You're really not going to learn much. Oops, what do we want here? We don't want the weeklies. We want the intradays. There we have it. Oh, actually, you will. Look at that. So I'll eat my own words on that one. A little bit ahead of myself, but these are barreling down on 203.25. So keep it simple. 203.25 is your key inflection point there. If we're looking at the market internals for the Russell, strong volume outflows is the only index that got to substantial on that Friday move. The advanced decline line was not in trend lower zone. The cumulative builds, obviously much more bearish compared to what we had in the other indexes as well. Let's jump on over to the profile for the Russell, and this really speaks magnitudes, right? Here is your sort of Wednesday recovery effort to get over that level we just saw, right, which was 203 and some change. You had a poor high that needed some repair. What did Thursday do? I mean, it tried to find the higher low, right? Oops, we want something like this. Value was over the higher low. But Friday just completely, again, throws a wrench in the mix for that particular lineup. So small caps are a top watch, especially as the focus likely comes off of NVIDIA. NVIDIA, just to sort of touch on this for a moment, I believe that the order flow is going to dramatically change with the options premium not being as enticing. So if NVIDIA is no longer acting as a major push-pull for the market and it's just sort of more neutral, people lose interest in it, number one, that could potentially cause some money to flow out of it, any short-term traders who are looking for momentum. But number two, it shifts the focus back on other things outside of the technology sector. And when I think about things outside of the technology sector, generally I'm thinking about financials and healthcare. And the broadening nature of those sectors, to some degree, I'm not talking about the mega cap companies, obviously, like JP Morgan, Eli Lilly, we put those aside. But if we're talking about the broadening nature of these sectors, the focus comes back to small caps. And small caps certainly don't look good as we've walked through in today's session. So I'd love to be proven wrong, but the technical picture right now in smalls is just not all that enticing. All right, small change in plans here. We're jumping on over to TradingView because Thinkorswim went down for maintenance as soon as we jumped into the S&P sectors. So bear with me. I'm going to do my best. I'm not as fluid in this platform. I might fumble around just a little bit in the second half of today's analysis. But if I recall properly, leading the sectors in terms of weekly performance was the SMH, and then we had the XLV, and then the XLK. So that's still looking like a risk-on posture as the market's breaking out to new all-time highs on that Wednesday session. If I recall properly as well, at the bottom end of the barrel, it was utilities, then we had the energy sector, and then we also had the XLB for materials. Those are all extremely lightweight sectors. Utilities specifically is D for defensive, so posture's okay here as we're breaking to new all-time highs. If we're thinking about structure, let's begin on the XLK chart. Any consolidation over 212 is bullish, breaks into blue sky territories is bullish. We would only reconsider this chart if there's a clear offering of a lower high underneath 212. One of the other interesting nuances to at least point out here is the lack of a higher high, the lack of an all-time high on the Wednesday breakout. There's actually a lower high on the chart, and that's slightly divergent to the broad market. However, is that overly concerning when a bulk of the analysis that we've already conducted would suggest that a pullback is not totally unreasonable into the earlier stages of this week. I think that this is adding up so far. The primary change in tone really comes from the lower high underneath 212. Moving along to the XLV, this is sort of the third heaviest weight sector, but it is technically D for defensive. Buyers would like to see a higher low over 144.75 and then consolidation, or even just straight up continuation into the top end of the prior range from back here. If you're a bear, sideways pressure is okay, remembering that this is D for defensive, but price action, of course, speaks for itself. A lower high underneath 144.75 is downward pressure for the S&P. Here's the XLF financial sector. This is stuck sideways in a balance range up here, literally in the midpoint of that balance range, and everything was an inside bar after the Monday range. You can see we're tangled up around the 50 SMA, not really doing a whole lot of anything. This is certainly divergent to the broad market itself as well, and maybe an indication that things need to sort of slow down in the S&P index itself. If you're a bull here, you'd prefer to see the top end of the range. You'd prefer to see a breakout over the Monday high. If you're a bear, I really wouldn't be overly aggressive to the downside until we lose this breakout point, right? You can notice there was a break retest, and we've been pretty constructive above. This is where we had some concerns underneath the 50 SMA, but obviously with this higher low, right off the breakout point, again, to me, it's not really worth being an aggressive bear until you're underneath that once again, ready to really move this market in the downward direction. XLY, what's going on with consumer discretionary, sort of retesting the bottom end of the previous overhead balance. I'm still sort of thinking that there's an opportunity for a lower high rejection here of 177.75. I'm not sold on the idea that the discretionary sector is going to act as a huge tailwind for the S&Ps. I mean, if you look at Tesla's daily chart, it's brutal. If you look at Amazon, the daily chart has gone nowhere over the past couple of months. It's actually setting up a really large possible weekly double top. I mean, I'm just not sold again on the sort of strength in discretionary. So looking for a possible rejection here. If it does pull back, I mean, buyers want to spot some sort of higher low. The level you might pay attention to is 176 flat. If you're over that, maybe you could count trend something like this, but you're really just compressing at that point into a little bit of a wedge. So leaves a bit to be desired. Let's take a look at industrials. It's towards the lower 50% of its balance range. I'd be more concerned if it made a new swing low underneath 120.50. Let's take a look at communications. This great breakout. This was one of the things we talked about in last week's Saturday update video. Great breakout, easy opportunity for a higher low over 83.15. Previous, opening print of that larger red-bodied bar, bearish engulfer. We had talked about how it never made a new lower low underneath that. We were over the 50 SMA. This chart just looks absolutely stunning to me. So if we're looking for bullish pressure across the broad market, we would love to see a higher low, then an all-time high test out of communications. That would be big time. Now, it's not going to sort of make up for the fact if, financials break down or go sideways. It's not going to make up for the fact if the XLK finds a lower high underneath 212. But if the XLK is sideways above 212, if financials continue to chop around in the range and communications can do this, that would be bullish pressure for your market. Moving along to consumer staples, you can clearly see the 100% retracement. Consolidation is in force, looking for a breakout here. Now, this is a D for defensive sector, so if this breaks out, that would be helpful for a reasonable rotation to take place in the market, right? Let's say that some money flows out of NVIDIA. Does it flow into things like consumer staples? I mean, it's not like the biggest risk-on indication, but at least what it does is it dampens some of the downward pressure that may otherwise be applied in the S&P 500. If the money is rotating out of tech into something else, that is rotation. If the money is rotating out of tech and just sitting in cash, that is much more bearish for the S&P. Moving along to the XLE energy sector, this is breaking down underneath the big monthly inflection point. If I just zoom out on this chart, perhaps reset, here we go with not knowing the exact workings of TradingView, right? But there we go. Big failed breakout on the monthly time frame chart. So a big win for inflation. That's really the way I would look to interpret the XLE chart here. The lack of acceleration, the sort of big time lower high back inside of the range. I think that this is getting a little bit, I don't want to call it oversold because things can always remain oversold. But if this were to just start stretching a little bit further to the breakout point from back down in here, I would tend to think things can stabilize, noting the strength of the down move that we've seen so far. It's basically a 100% retracement of the breakout from this as an inverted head and shoulder. So a little bit long-winded for a sector that's not really heavyweight in the S&P 500. So we'll move along to utilities. Double top definitely in play, not underneath the neckline yet, but if we zoom in a little bit on that Friday bar, I mean, man, that is pretty ugly looking. Gap fill reversal closes extremely weak at the lows, starting to suggest the breakdown of the neckline. If we're under 70, you've got really thin structure until the retest of this breakout point at 67.15. So it is a very lightweight sector. It's not going to move the needle too much, but considering the strength that it had back here, a little bit of cooling off would be a-okay in my opinion. A weekly higher low is likely found somewhere at 67.15 if the breakdown does take place. Here is the real estate sector, still tangled up around the major double top neckline from the weekly perspective. It can't make up its mind. It's really just range compression at this point. I would not look into this chart any further than that. XLB, it's got to show me a new swing low or a new swing high before we're concerned about pressure for the broad market. Then the Mac Daddy at the very bottom end of the barrel here is the SMH Semiconductors. What's going on with the VanEck semis? You can see any consolidation over 246.75 is good to go. Rock and roll, looking for continuation into blue sky territories. That's bullish pressure for the broad market. If it pulls back below that, you could probably say, okay, here's where your pullback comes in the S&P 500, at least to that daily line in the sand. I would give the SMH weekly room into this level here at 229.25, right? Big flat top area of resistance. Here's some daily consolidation that took place above. If there's a more meaningful pullback with money flowing out of NVIDIA on this possible split and the lack of enthusiasm there, this would be a major watch out of the SMH. And what I would do, just to give you maybe the insights into a possible trade idea or a setup, is let's say that NVIDIA breaks down aggressively and the SMH is coming into this level. When the SMH is here, I would double check the NVIDIA chart and say, are we near an area of support? And if so, I would start thinking about potential pullback longs out of NVIDIA. So there's just a possible idea for you. We've got some ratios in TradingView, and I think if I do this, yeah, there's a line chart. We could turn off our moving averages. We don't need those. And again, here's me sort of fumbling to make sure that this stuff is working somewhat for us on this weekend's analysis. This is the tech sector versus the S&Ps. We don't have a ratio grid. They're all individual. I like the rebound off of these lows. I would prefer to see some sort of new swing high. We know that the XLK structural chart itself is divergent with a lower high, so this is not shocking here out of the actual ratio. If we look at financials, it's got to really recapture a little bit more here. I'm not fond at all of the financials breaking down underneath this area. This rebound was looking good, but the new lower low and consolidation down here, or at least the opportunity for a lower high underneath the bottom end of the range, that's a major red flag when we're talking about relative strength and weakness. XLY has been a big concern for a while. The structural chart's really not much of a surprise over there. XLV, it's not really screaming like risk off is right around the corner. Not overly concerned with that one. Utilities, I like this breakdown. I like also, I suppose this is maybe one good thing about TradingView is that you can zoom out a little bit more easily. I mean, it's a really long-standing downtrend. It's not like even as utilities were outperforming as the market was trying to bottom after that pullback in April, it's not like we were aggressively making new highs out of the ratio. So that's perhaps something to have in your back pocket. But the breakdown here is suggestive of risk off not being a threat, right? Same thing over here out of the XLP over the SPY, big downtrend back towards these lows. Risk off is not really much of a threat. Here is okay, so now we're getting into our specialized ratios, it looks like. I'm trying to keep track of things. So you can see up there XLK, XLU. This, in theory, like I would have preferred if this could have been back over, right? And this is sort of, I'm trying to make my way through the levels we had on the Thinkorswim charts, but I would have preferred if this was really happening, the all-time high that is, over this shelf of previous support, because this can still act as resistance, right? We've talked about that. The one saving grace is that as the market made a higher high, the tech sector relative to utilities also made a higher high. Now, granted, not in the scheme of this all-time high, but at least in this interaction right here, I do like what happened into the end of the week. So there's that, but it's not a saving grace. And maybe it keeps us mildly bullish. Here's the XLK SHY continuing to poke in the upward direction. Again, would prefer to have seen a higher high with that on the Friday session. And let's see if the XLY, XLP, here we go. We've got ourselves flat lows. So if this breaks down, we know that here is the previous balance range. Remember that this thing had been stuck in a range for quite some time. If this breaks those lows, that starts to become more concerning here out of this particular ratio. Let's move on into, let's see if we can do this all seamlessly. Let's get into the dollar. And see if we can talk about the dollar. I think we can look at candles now. we're doing all right navigating the platform here. Not the worst thing in the world. Let's go ahead and adjust some of these levels. So I can't speak to the accuracy of all of them. I should have double checked before, but we'll do it in real time. What do they say? F it, we'll do it live, right? So any consolidation up here still kind of keeps this in the upward direction. Remember, a higher dollar should be downward pressure for the markets, the equities markets, that is. So any consolidation over the 104 handle out of the dollar, I would tend to think that we could stabilize in here, build out the consolidation, and try for another push over the 105.50. 105.50 is a much longer standing top end of the balance range from back here. If that were to clear in the upward direction, I would have to imagine deeper pullback is in store for your S&P 500. Next up, we'll move along to gold as we're talking about currencies, right? This aggressively broke down on the Friday session. And of course, the breakout in the dollar, if we just quickly flip back over here, this big move to the upside, and the breakdown in gold here on the Friday session are of course due to what we had out of the labor report. And we'll get to the labor report in just a moment, but interest rates went in the upward direction because apparently the NFP, non-farm payrolls, came in incredibly strong, right? So if that's the case, rates can stay higher for longer, your dollar's going to move higher on that instance, and gold, alternative assets, will move in the downward direction, right? Which is just kind of interesting here in terms of that relationship. Silver, aggressive in the downward direction as well. Let's get into, so typically what we do is we look at the 10-year, right? And on the 10-year, we do have to talk about 4.33 because we originally started breaking down under that earlier on towards the midpoint of the trading week, and this big recovery on Friday sort of wiped away some of that progress if you're looking for rates to ease and, again, a more easy operating environment for some of your companies that require borrowing cash to function, right? So the other thing we could do here as we sort of continue to navigate this platform, let's use the trend line tool. Let's be precise in what we're using. There we go. We had originally started to break this trend line, and it was after a lower high here. So if you're looking at the chart, you're trying to be constructive on the 10-year moving in the downward direction, which in theory would put upward pressure on the equities market. This recovery on Friday sort of throws a wrench in the mix of that analysis. So I'd continue to just use this horizontal level at 4.33. I'm not completely sold that the labor report is just suddenly going to, save markets. There are some pretty big discrepancies in terms of the way the data was reported. If you look at the ADP versus the government read, if you look at the household survey, the numbers are staggeringly different across all of the different metrics. I'm not a believer that the ADP that the non-farm payrolls on Friday tell the true story. Unemployment rate, sure, at 4% is fine, but to see the 10-year this aggressively higher on that read, I don't know. I do believe, let's move to the 2-year, which is closely what the Fed mirrors, right? The Fed funds rate. I do believe that higher for longer is still in store. And then I think that the first cut can maybe happen into like the early stages of 2025. And I'm getting a little bit sort of subjective here instead of objective, but it's just not my view that we've completely tackled the inflation issue. And the labor market, apparently, based on Friday's numbers, is still pretty robust, and we're not seeing major cracks. As my sort of belief here is that the Fed will start doing something about rates if the unemployment rate really starts approaching 4.25, maybe 4.5. That's where I think Jerome Powell starts to step in and intervene. So we can just jump directly over to our watch tool. There's really not much to cover over here. We know that the sort of November timeframe meeting has been back and forth with the September timeframe meeting. These odds were slightly higher before the Friday report, somewhere around 57% odds for that cut coming in September. So that's been dialed back slightly. I think the market's sort of in agreement with me in terms of saying, I don't think Powell is going to respond to these numbers just yet. It's not enough to get him up and over the edge. Inflation's still too hot. If we take a look at those numbers, here we go. So this is the calendar from last week. Here are your hourly earnings. So a 0.4%. That's a little bit more indicative of wage price spiral and, sort of wage inflation compared to the expectation, which was here at a 0.3. It's a little bit more sustainable. The hourly earnings can outpace inflation slightly. So you want 0.3s, 0.2s. That's okay out of hourly earnings, but you don't want 0.4s. That's for sure. There's the non-farm government read at 272,000, 90,000 more than the expectation, especially when compared with what we see out of ADP non-farms coming out on Wednesday, which missed the expectation and only read at 152. So something's not adding up here. The chef's out back potentially sort of, let's not get too conspiratorial, but skewing the data here on the Friday read from the government. So unemployment rate, 4%. That was pretty much in line with expectations considering what was going on with our Thursday initial claims. Remember, we were looking for this to ultimately show up in the data, and it definitely did by ticking that in the upward direction. Let's take a look at a couple of different things here. I know that this is a puny chart, but let's talk about perhaps, can we zoom in on this? Can we? No. Let's try to zoom in. Nope. I think oh, there we go. Let's do it this way. Thank you, Kathy, for posting the chart. But the main thing I want to show you here is the PMI services report. And the idea behind it is, if you notice, so what we want to look at is the yellow component here, which is, let's see if we can get the right tool. There we go. Yellow is going to be your prices paid, and the employment is going to be in green here. And then our actual business orders are in blue. So prices paid are coming down as orders are going up, and that's technically a good thing, right? That is actually going to help the disinflation process, right? So I did want to point out some good news on the inflation front when we actually look into the details of the PMI report from, I believe that was on Wednesday, if I'm not mistaken. I can't even remember at this point. When was that? Yes, Wednesday. Here it was, ISM Services PMI. As we continue through some of the data, here we have our JOLTS, and this was earlier on in the week. And something that I want to point out here, this is the net change month over month, is that jobs are being reduced, obviously, but you are seeing some additional jobs come in here. This is the pink section in professional and business services. So if that sector is hiring, if we just saw that wages are potentially moving in the upward direction, what does this say about services inflation? Because professional and business services, I mean, they're not producing goods. You don't go to those people to buy candy bars. You don't go to those people to buy shirts, right? So services inflation, good news on the PMI front, but hiring remains robust there. If they're going to be competitive with their wage offerings, I do believe that sort of continues to spur somewhat an inflationary story. Now, it's not the end of the world. Let's take a look at some additional data here. This is the non-farm payroll net, not net, but yeah, it is net. My apologies. Month over month. Where were the jobs added basically are what we're looking for here. And what we'll notice leads is really your services still. Education and health services. There we go. Construction. That's a little bit more so on the good side, right? But generally speaking, again, these goods, these services, here we go. We're getting all skewed up in our words now. This is what happens when Thinkorswim goes down. Totally throws you off your ball. But the services side of inflation, goodness, let's get this straight, Matt. The services side of inflation continues to see pressures from the labor side that I believe to stay competitive in some of these like sectors, they've got to be offering the higher wages. And I do believe that's sort of why on the Friday session, not to again sort of get too off the beaten path here, I believe that's why the hourly earnings are hot. That's my take on why the data has come in the way it ultimately has. Let's move on over to this one. This is what I wanted to show you in terms of discrepancies between who is actually reporting these numbers, right? So this is the response rate for the Bureau of Labor Statistics. Notice that less than 50% of people that the survey is sent to respond. So if you want to talk about the accuracy of the data, I don't know. I would start to lean on the ADP non-farms and say, is that perhaps a little bit more accurate when it's reflective of, literally what they have in their system, logged in their system, anybody who uses that service, right? So to me, I think that this is a tale of two totally different sides and a tale of accuracy that's maybe not exactly where it needs to be to draw concrete conclusions. So we'll keep an open mind, but that's what we got last week. As we look forward, let's get some of this sort of choppy analysis through in the rearview mirror, and let's just look forward now. We've got ourselves the CPI coming out on Wednesday. That's in the morning session, 8:30. We'll have coffee and donuts up in the penthouse early on. And then at 2 o'clock, it's all about the Fed, right? We're going to get the announcement of a pause, very likely, as we just saw to the tracker tool. But most importantly, the economic projections will be updated. I'll be keeping a very close eye out for this. We'll see if the Fed's going to adjust their targets for longer run inflation, whether or not they're still forecasting at this point 3 cuts for the year of 2024, if that's going to diminish to 0. We'll see. That's going to be huge information here, and we'll break that down on the Wednesday midweek market update after the market closes there. Of course, Jerome Powell during his press conference, PPI always follows CPI, or at least it should. And then as we move into the remainder of this week, we will have preliminary consumer sentiment and inflation expectations. Those move the market, not necessarily the revisions. If we take a look at the earnings calendar, here it is. That's last week. We're all over the place again. This is what happens when things get crazy. The top watches are going to be out of Oracle. The top watches are going to be out of Broadcom, which could be a contender at the price point it's at to take some of the NVIDIA options flow. And then also Adobe here into the Thursday session after the close. That is going to be your highlight out of the earnings calendar. Let's jump back on over to I was going to say Thinkorswim, not Thinkorswim. We'll jump back on over to TradingView, and let's finish up this analysis with our risk appetite. So this is the TLT ratio to the S&P. I suppose we could go over here. The other thing we could do, I believe, we don't want to double click that. We want to click on this twice maybe. Here we go. And let's make this line. There we go. That's the trade Brigade green, patented green. So TLT ratio to the S&P dipping in the downward direction here into the end of the week. That would indicate stronger risk appetite. This is the SHY over the IEI. So these are the bonds in relationship to themselves, right? So in the shorter term, I do like the possibility for a lower high. As this moves in the downward direction, that increases risk appetite for the market. Let's move on over to our medium term. Same concept. We're really looking to see whether or not these downtrends can persist, and that would increase risk appetite. And this is the longest time frame one that we watching for that same lower high. This is the screen that typically all three are on the same, and then we have the S&P underneath, just to give you an idea of where we're at in the run of show here. This is your credit spread, and this is the longer run one, and you can see that it's very stable down here towards these lows. That's a non-issue. And this is the shorter run credit spread, a little bit more volatile in terms of the range that is traveled, but I mean, it's still sideways towards the low. So risk appetite appears to be much more in line with favoring buyers in terms of sellers. If we look at the HYG, let's move on down to an hourly time frame chart. And what I think I can do here, if I'm remembering all of my sort of, here we go. Can we do that same percent scale? Yeah, this will be good enough. It'll at least help us understand what's happening. What I want to do, though, is get the HYG. Can I break that? No, I can't. Okay, a little bit frustrating. The main idea, what I'm trying to illustrate, is that if you look from here to here out of the HYG, obviously you have a lower high. If you look from here to here in the SPX, the S&P 500, which is orange, you can see that we have a higher high. So this is still divergent out of the sort of relationship between junk bonds and the market. And again, this sort of sides more with a pullback not being unreasonable. You'll also notice, even on like the more minor front, right? Look at this consolidation. This is the same consolidation right here. Look at the lower low out of the HYG, whereas you technically are holding a higher low out of the SPX. So that divergence is bearish in nature. Bitcoin is up next. What's going on with the digital gold? I think we can flip back to here. We could take off our relative S&P chart and we can go out to a weekly time frame. That's fine. We're really looking at this as a massive cup and handle on the weekly. Lots of folks are bullish Bitcoin here. I think rightfully so from a technical perspective. Inside of this box, looking for that to resolve higher over time. If it is going to turn into a weekly double top, you really got to be patient for a move underneath. Ooh, we do not want a percent scale. I don't even know. What have I done? There we go. You need a lower high underneath 61.4 if you're going to get a bearish breakdown out of Bitcoin. Let's start talking about new highs versus lows. This is something that can get flipped back over to a line chart, I suppose. And we'll go to a daily. And new highs versus lows, there are some concerns with breadth, right? We were starting to become a little bit more enthusiastic with the rotation away from the zero line, but into the end of this week, as we were making that higher high on Friday, breadth was actually contracting below the zero line in new highs versus lows out of the S&P. This is stocks above the 200 SMA, and this is a daily chart still. We can go to a weekly for this. If this breaks down more aggressively, I would not call that the end of the world yet here. This would normally be the SPX A200R. Here's the SPX A50R. This one a little bit more concerning because, as we know, it's a bit more sensitive, right, in the shorter term. And it's right at the 50% mark. Really, with the higher high on Friday out of the broad market, would have preferred to see a poke up and over the 50% mark. Not the case with what we see here. If we look at the RSP, what's going on with the equal weight S&P 500? We talked about this on Wednesday. We talked about, let's see if I can do this again without totally sidetracking the show. Same percent scale. There we have it. So S&P and the RSP, you'll notice, of course, here's your lower high out of the RSP. We're continuing to consolidate for lower highs. There was not even an attempt late in the week to get to an all-time high, never mind the top end of the range here. My concern out of the RSP would really emerge. Let's go to a candlestick chart with the RSP here. If we break down underneath these lows, that's where I would start to have some concern because it's a failure of your double bottom neckline, right? And that really would speak to probably looking for at least a pullback, not an outright collapse in the S&P 500, but definitely some sort of retracement in the downward direction. Let's take a look at the QQQE. No sense in having the S&P alongside that chart. What do we see out of this? Same process as the RSP, basically, where, it's definitely divergent to the NDX. If we just want to throw that one up here real quick, we can go NDX, great, same percent scale, and you'll notice, obviously, here's your massive higher highs, and we're just not even close out of the QQQE. So, again, apologies for a slightly choppier show as we get into some instruments that we're not typically looking at, or at least not familiar. It's the same instruments, but it's a different platform, obviously. Here's the VIX. What's going on with the VIX? Floored right back down towards the lows. So is there a volatility issue? Seemingly not. Again, we can probably, if I get rid of these percent scale things, can we see the normal numbers? There we go. So we're looking at 12 as a floor here. We're sitting right on the floor. If we look at the VVIX, this thing's completely floored at 75. So start being worried about your complacency effect. Again, tying into the whole picture of the analysis so far, there's nothing that's saying the S&P is about to collapse into a major downtrend. We're going to start trending. It's going to be a bear market. Oh my goodness, look out below. However, a pullback's really reasonable. Pair that with the complacency effect. A little bit of an uptick here. I think you start to get some people scared. You get some money flowing out of NVIDIA, as we've already described. I think all of the pieces of the puzzle are there. Here's the VIX futures. This is actually good. This is good. I was like, did I have it set up for contango versus backwardation? It looks like I do. We are over the zero mark, meaning that we are in a stronger contango, which is technically bullish for money managers to want to allocate capital in the present day versus more risk, instead of less risk in an unknown future, right? So there's more risk in the unknown future, less risk in the present day. Good for allocating capital. Once again, that is a bullish indication. I am going to cut the video here, and I am going to make sure that the core list of companies have accurate levels, and I'll be back in just a moment. Kick things off with the Apple daily time frame chart. What do we see here in terms of the overall trend? It's certainly in the upward direction, and what I like is this big breakout point here around 192.75. If there is going to be a stronger pullback across the broad market, I would still be thinking about a daily high or low there, then continuation into the all-time high as a potential upside target. If we lose that, obviously, on the daily, you start to emerge with a head and shoulders, and a stronger trend reversal may be underway. If we take a look at the hourly time frame chart, you can clearly see the market is stair-stepping in the upward direction here. Any continued price acceptance over 170 or 196.25 is looking pretty good for continuation into that next target, which, as we just saw, is up closer to 199.25. Next up, we've got Microsoft. What do we see out of Softy? Huge V-shaped recovery off of these lows, but the overhead balance range still persists here. Any consolidation in this area over 421.25 is good to go. Thinking about bull flag consolidation from this context here, breaks and higher lows on a recapture of 426, we'll call it for round number's sake, get us up towards the top of that balance. That is a bullish trade. You could start to think of this as a cup and handle setup as well. We're still on the hourly time frame chart. If we go to a daily time frame chart and reset the view really quickly, the whole idea here is that we want to try to see if we can get higher low consolidation and poke into the overhead supply. If this is a harsh rejection on lower highs underneath that 421.25 level we were just describing, this really starts to feel more so like a distribution zone, and we're just rejecting, again, the top end of the range. So highs, lower highs if this sticks, but the actionable setup is the lower high underneath for a thin structure retracement. Things really fall apart if we lose the daily 50 SMA and the breakout point of the 3 back-to-back hammer equal highs at 416 flat. Let's move along to Google. What do we see out of the Goog? Remember that these are all-time highs. We're pulling back for what maybe could start to be considered a little bit of a double top. The reason I say that is because if we look at the hourly time frame chart, we tried to get price acceptance in there, and when I say in there, I mean over 176.50 early on in the day session from Friday. That would have been over the inverted head and shoulders neckline from back here, but no acceptance. So, the more time that this sort of spends in the midpoint of this as an overall balance range, the less excited I am about potentially looking for breaks into blue sky territories. All it would take is the loss of this level right here at 173.50, and I think the door is open for equal lows down here. Sure, you'd have to contend with 171.50, and we'll take it in stride from there, but generally speaking, if this was going to break and really go, right, as soon as you got over this resistance trend line, would have been better to get consolidation here and then look for follow through in the upward direction. It's simply not taking place. So a couple of outcomes into the early stages of this week, right? Any retest lower highs set up an hourly downtrend to emerge, or break, and in here, it's the same concept. Look for that lower high underneath the rejected neckline from this as an inverted head and shoulders. Amazon, Nancy. What do we see? Let's go to a daily time frame chart. I was talking about Nancy earlier in terms of the daily not looking so attractive. This is what I mean. I mean, you've got this updrift, big downdraft, updrift, big downdraft, right? And it's really going sideways inside of a balance range. It's not really cleanly trending out of the daily, which is why your XLY is sort of struggling to the magnitude it is. We're in the midpoint of this range. As we know, you don't diddle in the middle, but if there is going to be a breakout trade, I could really envision two things taking place. Let's go back down to the hourly. I'm sure you can start to see where my head's at. If this is going to be an inverted head and shoulders, any higher lows that are over, I would argue the daily 50 SMA, this is the daily transposed to the hourly, and also this level in here, right, where this most recent leg to the upside came from at 181.93. or 182, let's call it for round number sake. This is the issue with not having Thinkorswim, right? We can't just go round numbers only. I get it. I could click it and I could, sort of move this thing up penny by penny here. But let's be honest, I'll be back on Thinkorswim as soon as they're up in business on Monday. You get the idea. Any higher low there sort of sets up the pattern. If the bears were really going to make something happen, it should have been a lower high underneath. So it just didn't take place, and as of right now, I think the bulls are fighting back with a little bit of a vengeance. Again, the daily trend is still very neutral. It's not doing anything impressive there, but the higher low at least captures my attention. I would look to execute on that idea. It's been a pretty much nonstop move from straight, off the lows, straight up into these highs here. Let's move along to NVIDIA and see what's going on with the one stock to rule them all. So I think it's very straightforward. This is going to split, obviously, 10 for 1 coming into the Monday session. So just take this value divided by 10. Obviously, we'll be trading around, $122, $123 a share or something like that. If we're consolidating in this range, it's just consolidation. If the market's going to see some outflows from NVIDIA, it's going to emerge from a breakdown underneath those lows on the pullback from, what would that have been? Was that Thursday? Yeah, Thursday's lows, Friday's lows. Underneath that, I think we can start to look for the sort of money to flow out of NVIDIA. That's loosely around 1187. So again, if you're thinking in terms of split adjusted numbers, 118.75. If you can spot a lower high underneath that, I think at least a retest of this breakout point is underway. That'd be about 4 points lower into 114, again split adjusted here, moving that decimal point a few places to the left. Let's move along to AMD and see what's going on with the non-splitting chip company, if you will. It's doing nothing. It's inside this balance range. I'd be interested, like, if it can get over this 168, level in here, 168.25. If we can get consolidation there, good. But it's just a first step, remembering that we had a failed break. It's really got to prove it to me. If we just quickly flip back to a daily time frame chart here, recall that if this entire range is really going to resolve, you want the thin structure retracement. That's the better trade out of AMD, and that's really going to require some patience until you're up and over loosely 172, 172.25. Again, the more precise numbers will be available on the morning show for the pre-market prep on Monday morning, or you could go back and you probably capture a lot of the same levels from the Wednesday update video, which I get not many people saw, but Metaverse, what do we see breaking out of this range? So solid move. Like when we're talking about thin structure retracements, when we're talking about AMD, right? Get us out of that range so we can experience days like what we had on Wednesday. That's a great looking move there on Wednesday out of Metaverse. If we can get a pullback here in the fantasy land to retest the top end of the balance at, let's just call it 481 for round number's sake, daily 50 SMA, great spot for a daily higher low. Looking to sort of engage with longs around that area and then trade it right back into the equal high. If we take a look at the hourly time frame chart, how might this be achieved? Basically turning this into an hourly double top. Lower highs already enforced, bring me some sort of lower low. I think you have a retracement to the downside, getting you to that target we were just describing on the daily. If it's consolidation and then a break and higher low here, I will change my tone. I would be willing to go with the momentum in the upward direction, considering that the daily range, right? This breakout, it's a long-standing bull flag. If you're going to take the measured move, there's two things you could do. Balance range, we've already doubled it. We're home at that target. If you take this and stack it on bottom of the flag consolidation, ultimately that brings you a little bit higher to the origin of this breakdown ahead of the earnings announcement. Moving along to Tesla, very similar to AMD. Here's this really constrained balance range, not doing anything interesting whatsoever. The reason I say it's the same as AMD is because even if you clear 180, which we know has been sort of the heartbreaker level, you still have to run into this, right? The better trade is the thin structure retracement over the 186.65, we'll call it for round number's sake. That is more attractive in the upward direction. If it wants to sweep these lows, it tried to do it on Wednesday. No love there. I suppose that was not the day to try for it when the broad market was gapping up. If the broad market's weak and we take this out at 173 in Tesla, I'd probably take another stab at it, just noting that all of this is going to continue to act as overhead supply if we're under the 173. Next up, Netflix. What's going on? Is this turning into a head and shoulders? Perhaps. It's all over the place. I think that this really requires the hourly to make more sense of your ups and downs here. If the neckline was going to hold, right, you probably shouldn't have seen this breakdown end of day on Friday. It also should have gotten acceptance here to avoid the head and shoulders, right? You would have really not seen that right shoulder emerge if the consolidation held, and then you traded into the equal high. So with that sort of in force, I think that we're in a tricky spot to actually execute. You might be able to get like a Stevie Wonder directly off of the open on Monday. If we're here over the 640 level, breaking 640, I think that you can swing for the thin structure retracement, but I don't know that I would overstay my welcome into the top end of this balance at 635, we'll call it for round number's sake. So quick trade, something to get us here, reevaluating at that area, and then really just range rules are in place, right? You've got highs, you've got lows. The market seems to be respecting that out of Netflix. In the midpoint of that range, I don't know if you want to diddle in the middle. Next up, we've got JP Morgan. Let's take this on. I think that the hourly chart actually suffices. Just the hourly, yes it is. The hourly chart suffices because we can look at this as the thin structure retracement target to the upside. Really interesting rally on the Friday session off of these lows, clearing this area and getting straight to the top. I love the high and tight consolidation. If financials are going to play nicely, we were just talking about the XLF chart, right? You've really got to see JP Morgan get in gear up and over this $200.25 mark. If that's the case, you're looking for this retracement back there. If that does happen, I would maintain the rotation stance for your S&P 500. If financials can catch a bid, as NVIDIA potentially pulls back, if the tech sector pulls back and financials get that bid, that to me would be constructive for at least maintaining a sideways balance in the S&P and just outright avoiding a big downtrend in the S&P 500. That is the core list of companies, but I've got 3 trade ideas for you, and we're going to have to put these levels on together in real time, so let's do that now. The big level in MU, I believe I was having down here at 129.50 over on Thinkorswim. And the reason for this is that we have now multiple failed attempts to break out, if I extend this off to the left, of this previous pivot high. We tried in here, we tried over here. Look at the bearish 3-bar play that's setting up. So this 3-bar play is the inverted hammer inside of the red body bar. If we break underneath the equal lows, I think you're trading at least into these lows down here. Let's go back to the hourly and pick off a potential target. It would be great if we could make a move all the way into, let's call it 125.30s. That would be the first sort of target area I would be looking for out of that trade. So double top, neckline breakdown, you could call it that way as well. This is the trade that we're looking to ultimately have unfold. That's Micron. And again, if NVIDIA is seeing some outflows, if the chip sector is running into some struggles here, some headwinds with that split, it's one possible idea that takes advantage of that. Next up is Coinbase, COIN is the ticker on that one. And I love the retest. Let's go to a daily chart. This was a trade idea from not too long ago when the Ethereum ETF approvals were taking place. We were talking about this as an inverted head and shoulders neckline, and I think that the retest is coming in hot and heavy here. If we can hold up over, let's grab our proper tool. If we're over 236, I think that this is a pullback buy towards the 50 SMA. I think you're looking for that as a possible idea out of Coinbase on the break, retest, high or low, then looking for ultimately equal high, and then possibly this from in the past. What is that level up here? Let's give you that at 280, we'll call for round numbers sake, right? Another possible, just reference point to have on the chart would be here at 260.250, which is what we are rejecting off of currently to produce the higher low in the first place. That's Coinbase. And lastly, we have Uber, UBER, if we could get the R in there. And what I like about this is the bullish 3-bar play. So we've got things for up, we've got things for down. We're looking for down out of MU. Coinbase could go either way. You could look to trade the pullback into the retest level or the long off of the retest level. And then Uber is more of the long idea. Coming off of this long-standing downtrend, this consolidation range post-earnings is completely beneath us now, and you've got a bullish 3-bar play at the 50 SMA on the daily. If you could take out those 2 equal highs, giving you the number we'd be talking about loosely, let's call that 69.69 just for the sake of laughs. There's 69.69, and the target would be up here, the origin of the red-bodied bar breakdown around 72.69. So there you go. Maybe it was fate. It was meant to be. You've got $3 in the upward direction as a possible breakout trade. It's not going to happen in one fell swoop, but it might take a little bit of time there, a couple days to unfold higher, and I think you're in business. That's going to do it for today's episode of the Weekly Watch List, the weekend update. I appreciate you guys bearing with me as we had to switch platforms and update some of our levels. I know those weren't the cleanest levels out of the charts over here, but there's no sense in doubling the work. It's already done on Thinkorswim. I'll try to share some of those charts on X. If you're not following us on X, keep a lookout over there. We'll post all of the core list of companies. We'll do the mega thread of analysis. We'll do everything we typically do, and you can check in on the most accurate and up-to-date maintained charts that I use on Thinkorswim. Hopefully, if the platform's resolved by tomorrow, I would hope so, right? Anyhow, that is going to do it for me. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. We will be live at 8 o'clock on Monday morning for the pre-market prep. We hope to see you there in the penthouse. We'll have coffee and donuts on Wednesday. We've got the CPI coming out on the morning session. So we'll see you there. Have a green trading week, and I will catch you in the next one.